when I was going through the slide, and they basically said like the same thing twice about how like the Fed adds money to the money supply. The second one, which I didn't realize, was loans to financial institutions. So the point was that whether the Fed's conducting open market operations or whether they're lending through the discount window to banks, it's going to have the same like exact results. So that was the general point of that. Yeah, that's the only thing I wanted to say about that. So we ended with the critique of the simple model. Obviously, for the multiple deposit money creation, where one bank lends out money that they get paid, and so a open market purchase of $1 million or $100 million is going to end up with like $1 billion of increased money to the money supply. That simple model doesn't like hold in real life because people holding cash stops the process, or if they hold excess reserves above what the requirement is, that's going to decrease the amount of expansion of the money supply. So it's not going to be $1 billion from 100 million, it's going to be less than that. So it's not only the Fed policy, but it's also depositors' decisions and banks' decisions for how much currency and how much excess reserves that cause the money supply to change. So while the Fed doesn't have complete control, they have probably the most control out of the three players in this model. Something I mentioned, I think last class, that I just want to define for you guys is insolvent versus illiquid. So when they say it's illiquid, it means they don't have enough resources available to meet their current obligations. So basically, think of it, you can pay your bills or you can't. So they don't have enough cash on hand or assets that they could easily sell to cover the liabilities. So the money they owe to, say, depositors or to other banks or to the Fed for discount loans. Illiquid it's bad, but it's not life ending for a bank, because even if they can't get money in the short run, as long as they can borrow enough, they'll be able to forestall having to shut down, and they can sell those assets, the illiquid assets, off at a later time. Obviously, liquidity is how easy it is to turn your asset into money. So maybe like common stock is super liquid, whereas super liquid. One of their banking facilities, it's going to take a long time to sell that property, whereas stock's super easy to sell. On the other hand, insolvent is owing more than you own. So you don't have the resources to cover your liabilities. So like take the whole value of your assets, and those aren't enough to cover your liabilities. So even if you were able to sell everything off in the short run, you still wouldn't have enough money. So what we really see this happen, or when we see it happen, is like, for instance, in the financial crisis, when the value of all these banks' portfolios crashed because the market lost a lot of value. Suddenly, banks that were solvent, that had enough money to cover, or had enough assets to cover what they owed, suddenly they don't. And this is when the banks either need to be bailed out or go bankrupt. The basic banking model, to borrow short and lend long, naturally leads to fragility in the banking system, and during times of falling asset prices. So yeah, something we're going to talk about in Money Free and Unfree a little bit later is in crises when central banks should lend to troubled banks and troubled financial institutions. If a bank is, let's say, the economist Walter Bagehot, who was writing in like the early 1800s, he said that if a bank is illiquid but they're solvent, they should lend to them. But if they're insolvent, they should not lend to them. The insolvent bank has been too poorly mismanaged, their financial situation is too difficult to save, to get them out of. But an illiquid bank just needs some money in the short term until they're able to sell their assets, and then they can easily pay back the central bank for lending to them. I also mentioned that Germany tends to be really tends to be inflation hawks in the European Central Bank. Less than 24 hours after that class, the German board member on the ECB stepped down because she said monetary policy was too loose. This is just a practical example that they still haven't forgotten about the hyperinflation. Now, getting back to the chapter, we'll look at factors that determine the money supply. So there's changes in the non-borrowed monetary base. So these are open market, the changes that are that occur through open market operations. And the money supply is positively related to the non-monetary base, or non-borrowed monetary base, excuse me. So if the non-borrowed monetary base increases, the money supply increases. Likewise, if the non-borrowed monetary bank shrinks, the Fed, they sell bonds to the banks. That's going to decrease the non-borrowed monetary base and decrease the money supply. The other is changes in the borrowed reserves from the Federal Reserve. These are your discount loans. The money supply is positively related to the level of borrowed reserves from the Fed. So the more money that banks borrow from the Federal Reserve, the greater the money supply, and the reverse is true. There's also changes in the required reserves ratio. The money supply is negatively related to the required reserve ratio. So the Fed forces banks to hold more money in reserves. There's going to be less money in the money supply. Next is changes in currency holdings. The money supply is negatively related to currency holdings. So the more currency people want to keep on hand, the slower the money supply growth is going to be. And then changes in excess reserves. If there's high systemic risk or very low yields, banks tend to keep excess reserves as a form of safety, and because they can't make much money lending it out, so it's less costly to hold them. Now that the Fed pays an interest rate on excess reserves, again, banks are holding larger amounts of excess reserves because now they're getting paid for it, so there's much less of a cost.
So there's more excess reserves than there is money supply.
No, that's not what I'm saying.
Can you explain the reserve ratio?
So the required reserve ratio is just what percentage of assets banks have to hold on to. So the example we usually give is 8 or 10%. I think it's like 8 or 6%. Yeah, so it's just a small portion of their assets that they keep on hand. The rest they can lend out. And excess reserves, I showed that graph before. Like money supply was up in like the billions or trillions, and excess reserves in the millions. I mean, it's large for the banking system, especially compared to before, but it's not like comparable to the monetary base. And the money supply is negatively related to the amount of excess reserves. The more the banks keep on hand and don't lend out, the less money's out there in the economy. So the main takeaways from this money supply that we've talked about so far is that the Fed's liabilities are the money supply. So the reserves that banks have to hold with the Fed, and then the currency that they issue. There's also treasury money, which counts as currency, but that's just coins. So that's a very small part of the monetary base in the money supply. Pre-crisis, the Fed primarily used open market operations. That was their main policy tool. They haven't changed the reserve requirements in a long time, which was their original policy tool. And discount lending has become a much smaller part of their normal monetary policy toolbox. For a time, it was extremely popular, but the Fed got tired of banks. They felt they were over-relying on just going to the Fed instead of going to other banks. And then during financial crises, there's a stigma attached to it. It's seen as a signal that no other bank thinks that that bank is solvent enough or worthy enough to lend to. So for an open market operation purchase, that's expansionary. So when the Fed buys assets from a bank, they give that bank money in return for the assets, increasing the money supply. In theory, the bank then takes that money and lends it either to other banks in the federal funds market or to businesses and individuals. On the other hand, open market operation sale is contractionary. So in that case, the Federal Reserve is going to sell an asset to the bank. They give the bank an asset and they get back money, pulling money out of the money supply. Banks now have fewer assets or less money that they have on hand to lend to other financial institutions or to firms and consumers. So that's going to decrease the money supply, put a brake on economic growth. The Fed loan to private banks, so your discount lending is going to work exactly the same as open market operations. And the last takeaway is the multiple deposit creation process, whereby when the bank or when the Fed makes in our example, $100 million open market operation purchase, we see much more money entering the money supply as a result of that. If the reserve requirements is 10% of your assets, then it's going to end up leading to 10 times the amount of money that the Fed makes in the purchase. In the $100 million purchase example, that's going to be $1 billion. And then obviously holding money as currency or holding money in excess reserves is going to decrease the amount of expansion. It's going to hold it back compared to the frictionless example where all the money is lent out and there's no excess reserves. Okay, so this slide right here is this just breaks down the 5 things, I think 5, that I talked about earlier, summarizes it very simply. So here we see the Federal Reserve controls the non-borrowed monetary base and the required reserves. So non-borrowed monetary base, open market operations, increase the non-borrowed monetary base, money supply goes up. If they increase the required reserves, money supply goes down. Same thing that I was just saying a minute ago. This is just broken down. These are for you guys to study, so it's like right there. You can compare them all. The next one is banks with the borrowed reserves and the excess reserves. If banks borrow more reserves, it's going to increase the money supply. If they increase their excess reserves, that's going to decrease the money supply. And finally, for depositors, the only way they can affect the money supply is the amount of currency they choose to hold. So if they increase the amount of currency they hold, increase the money supply. That looks like I made a mistake. Yeah, it's going to decrease the money supply. I'm going to have to figure out how to change that because there's less multiple deposit expansion. And this shows just the increases in the variables. Everything would be reversed if you did decrease. You guys have any questions about that so far? Nothing on the money supply. All right. So when we talk about the money supply, there's 3 main measures I'll say there's 4 main measures we use. The first is called M0, which is literally just currency. Go just the bills in your pocket. Normally the Fed or central banks don't really worry about M0 too much because it's such a narrow view of money. The first one they really look at is M1. And M1 is currency and then checkable deposits. So literally your checking accounts, because you can spend that just as easy, sometimes easier than using paper currency. This is like the money that you use in transactions. M2 is a little bit broader. It's M1, so currency and checkable deposits, and what they call near money. These are like savings deposits, money market securities, mutual funds, and other time deposits like certificates of deposit, where You can't use them as a medium of exchange. You can't actually, I don't know, like give them to other people as currency, but they're still very liquid. So you take the money out of your savings account and then you give it to someone else, or you sell your mutual funds, which is very easy, and then you use that money in as a medium of exchange. So because of that M2 is like probably the most commonly looked at metric for the money supply. And finally, there's M3, which is M2 plus what they call near money. That's actually not a joke, that's what they call it. And this is like large time deposits, institutional money market funds, short-term repurchase agreements, and larger liquid assets. These are much less liquid than what's included in M2. The idea behind M3 is this is the store of value idea of what a currency does, and this represents that. The Feds, they stopped keeping track of M3, I think in 2006, and even before that, it was a minor part in their idea of the money supply. There's a new measure, I think it's like MZM, I forget, that's basically like M3, a little more narrow than that. What they consider relevant near money and near money. So next we're going to talk about the money multiplier, and for that we're going to use M1. So we're just using currency and checkable deposits. This stuff you can literally use as currency in day-to-day transactions. So to do this, we'll link the money supply to the monetary base, and then M equals the money multiplier. So you have the money supply equals the money multiplier times the monetary base. So, because the monetary base is transformed into the money supply at a more than a 1-to-1 ratio. So I'm going to walk through some of deriving the money multiplier to give you an intuitive idea behind it, but it gets really mathy towards the end, so I'll just skip on all like the plugging in equations. But it's there both in your textbook and on the PowerPoint in case you don't believe me or if you really love math. So to do this, we're going to assume that the desired holdings of currency and of excess reserves grow proportionally with checkable deposits. This is done for simplicity's sake. Basically, so you don't have to worry about one growing faster than the other and then doing more complex like transformations. Yeah, so people holding currency and excess reserves, they're going to slow the money creation process. This is, as a side note, this is one reason why some economists want to end the use of physical currency, because it makes the money creation process less effective. Plus, it'll allow negative interest rates, substantially negative interest rates, to be practical. Yeah, so the first one, C, is the currency ratio. That's literally the amount of currency in the economy divided by the number of checkable deposits. And then the excess reserve ratio is the excess reserves divided by checkable deposits. Okay, so the total amount of reserves is the sum of required reserves and excess reserves. That makes sense. That's literally two types of reserves you can have. And the total amount of required reserves is the required reserve ratio times the amount of checkable deposits. That little tick apostrophe there, for some reason, is how the PowerPoint uses the multiplication symbol. I'm not really sure why. So if you substitute in the required reserves into that equation, you get the total reserves equals the required reserve ratio times the number of checkable deposits plus the excess reserves. And as a note, the Fed's going to set R as less than 1 because we're in a fractional reserve banking system. It's Our example will probably be like 10%, but I forget, like 6 or 8%. That's something I should know if we're going to talk about in class. Yeah, so that allows, with R being less than 1, that allows some portion of the deposit to be lent out, and our money multiplier to be greater than 1. So the monetary base equals the currency plus the number of reserves, as we said. So currency plus reserves. So that equals the currency plus what we got in the last equation, the reserve requirements times checkable deposits plus the excess reserves. Yeah, so we end up, the equation shows checkable deposits, currency, and excess reserves. Basically, those 3 components. Here's where the math gets a little more intense. I'm guessing it's too early in the morning for you guys to want to do this kind of math. But your basic idea is that your money multiplier equals 1 times the currency ratio divided by the reserve requirements plus the excess reserve ratio plus the currency ratio. And it's represented by that equation there. It's really intuitive, right? Instantly you know exactly what's going on now. No, so let's do like a quick example so you guys can get a feel for, there's a black one. Get a feel for what the hell this means. I'm going to write some of these down because the next slide is not going to have them. So R equals 10%. Currency in circulation equals 400 billion. Checkable deposits is 800 billion. Excess reserves are 0.8 billion. And money supply is C plus B equals and it's 1.2 trillion. So to get your currency ratio, you're going to divide, again, the currency in circulation by the checkable deposits. That'll leave us with 0.5. And then your excess reserve ratio, again, is the excess reserves, the 0.8 billion, divided by 800 billion, the checkable deposits. That'll leave us with 0.001. So we'll plug these numbers in. So we have 1 because that's what's in the equation. So the additional dollars spent plus 0.5, the currency ratio. So that gives us 1.5. And then that's divided by 0.1, the reserve requirement ratio, plus the excess reserve ratio, plus the currency ratio. So 1.5 divided by 0.601, is going to be 2.5. Now this is much less than the simple deposit multiplier we had earlier. The reason being is now we assume that the frictions that didn't exist before, we assumed didn't exist, now we assume they exist and we account for them. So we have people holding currency, and we have banks holding excess reserves. Because of that, the money multiplier is going to be a lot lower than our simple deposit multiplier was in theory. So even though we're still seeing the multiple expansion of deposits, that 1 additional dollar in deposits is leading to $2.5 entering the money supply. we're not seeing it at the same levels we did, with the simple theory. You can remember, although there's a multiple expansion for deposits, there's no such expansion for currency. One of the reasons why the Fed conducts open market operations and lends to banks instead of just handing out cash to people, because for that you just get a one-to-one increase in the money supply. So it's less effective than using lending to banks. Here we have the excess reserve ratio at 0.001. It's a very small component of the money supply. It really wasn't something that economists worried about when it came to the money supply, because it basically equaled zero up until 2007, 2008. Now it's much more of a concern. Because of the Fed policy of paying interest on excess reserves during the crisis, banks are now holding much greater excess reserves. So just to show this example in real life, by June 2014, all the Fed's quantitative easing and all of their open market operations leading up to the quantitative easing led to a quintupling of the Fed's balance sheet. So they went from basically $1 trillion up to $4 trillion. And there was a 377% increase in the monetary base. A great increase in the monetary base. Like I said, given the name quantitative easing, the increase in the monetary base did not lead to an equivalent change in the money supply. A lot of people were predicting that. Not just like politicians that were opposed to it, but a lot of economists thought that would happen as well. But it didn't happen, and that's because of the whole excess reserve, the increase in that. But as the model we just talked about, as it suggests, an increase in the excess reserves is going to decrease the money multiplier. So in this case, we see the monetary base, which includes the excess reserves, increasing substantially. It jumps up, increasing. That's your 370%. While M1, you see a little bit of jump there, and it continues on basically the same path. It only increased by 110%. So we don't see the giant jump money supply that we thought would happen. That normally happens when you see a jump in the monetary base like that. And that's because the currency ratio and the excess reserve ratio. The currency ratio here fell slightly over that time period. Meanwhile, the excess reserve ratio skyrocketed. It's much higher now. So the excess reserve ratio, that component of the money multiplier equation, because that increased substantially, we're seeing small growth in the money supply. That's why quantitative easing didn't lead to a great increase in the money supply. So that kind of shows this equation, shows these ideas in action. You guys have any questions here?
I think I looked up what the reserve requirement was, and it depends on the size of the bank. It's like if the bank has less than $16 million in liabilities, it's 0%. So that's interesting. And if it's between 16 million and 120 million, then it's 3%. If it's more than 120 million, then it's 10%.
Interesting. Okay.
But if you have less than $16 million in liabilities, then you can just lend it all out.
Yeah. I'm assuming they won't, because they want people to trust them enough to put money in there. Yeah, that's interesting that they do it by size. It makes sense, but part of their relief to small banks. Oh wow. Okay, so we'll end here for the day if there's no more questions.